You, Good day, everyone, and welcome to the first Smart Assets webinar of 2025. I am Razia Ghani, the Head of Investments at NMG. We've created this forum to provide some insights into what is happening in capital markets, both locally and globally at the moment, and what is driving performance within the smart assets portfolios. The economic and market overview will be provided by JB Smith, the NMG Asset Execution Executive, and he will follow this with a brief performance update on how the overall smart asset portfolios have performed, as well as what they cost, which we know is an all-important factor that can eat into savings. Thereafter, we provide you with a unique opportunity to hear directly from one of the highly skilled and independent asset managers who will shortly be joining the smart asset strategy and will manage a portion of your retirement fund assets. We're very privileged to be joined by someone considered a household name in investment circles, Mr. Andrew Cantor from Future Growth Asset Management. Future Growth manages a couple of slices of the assets within the portfolio, all of which are within the fixed income portion of the assets. You will hear from Andrew later in terms of how these portfolios add value to your returns. For those who may not know him, I'll run through a very brief overview of who Andrew Cantor is and why we are very pleased to have him join us today. Andrew is the Chief Investment Officer and a Director at Future Growth Asset Management, one of the larger independent fixed income managers, and a leading developmental investor in South Africa. Andrew's been with Future Growth since 1998. He came to South Africa in 1990 from the USA. You'll pick that up in the accent. And he's been a director of several infrastructure and development companies, ranging from toll roads to low-income housing finance and municipal finance. Andrew has been a CFA charter holder since 1989 and was a founding director of CFA South Africa in 2001, where he served until 2014. He lists fatherhood, travel, and scripophily amongst his hobbies, and he's also a regular cyclist. I feel like I can attest to this, as I did once see Andrew cycling into a baby expo. And so I think it talks at least two of those hobbies. And then without any further ado, I'm going to let us get going. JB, over to you to please enlighten us about these rather uncertain markets and hopefully leave us with some positive news. Over to you, JB.
Thank you, Razia. And I want to say good afternoon to everybody. Yeah, it's always fun to start off a new year. It's quite funny that in financial markets that and the human psyche, you kind of reset for the new year. And you think that last year ended, now everything starts afresh. But unfortunately, in financial markets, we kind of carry the burdens of last year into this year. I mean, you kind of need to make sense of what is happening. But I think if we kind of recap in terms of last year, it's been quite a funny year, 2024. And I want to say it's a year of three parts. So we had the beginning of the year where global equity markets, and I want to say more US markets, did actually well. And then we had the SA election. Everything went extremely well. And let's say the middle section of last year, local markets did extremely well. The Rand did well. And then at the end of last year, as we kind of started to move into the US election, uncertainties started to set in, and then US markets kind of picked up their head again. And our local markets actually kind of started to falter. So as we kind of look at the performances of last year, you look at world equities at almost 23%, at 22.5%. You need to kind of take that into consideration, those three parts that I've just mentioned. There was a time last year where actually our local equity markets was one of the best performing markets. And as we kind of progress through the year, that essentially has changed. But it has been a year where the US equity market did extremely well, 28% last year. And if we kind of look at global bonds, and global bonds essentially lost a bit last year, and that's all on the back of the uncertainty about growth, of the uncertainty in the growth, and whether it's going to affect inflation and what the interest rate outlook is going to be. Now, obviously, emerging markets never go unscathed when there's volatility in markets, but it's been an all China affair. The Chinese market being up 23% last year, but it's also been a case also of a certain months last year in which Chinese markets did extremely well. And we recall that it's about September, October last year where markets essentially picked up its head, the Chinese market, and that's on the back of quite a substantial stimulus package that was announced in China. And that normally will also affect our local market. And in the end, our local market ended up with about 13.5%. It's quite close to our long-term return for the market. And obviously our bond market did extremely well. I mean, 17% last year. I mean, just think about it. If you had to ask me at the beginning of last year, now at the back of this number, which asset class you should invest, and I would have told you, no, you should invest into the South African government. Now, this is kind of beginning of last year, going into an election year. I mean, I think you would have thought that maybe I've kind of lost the plot by saying that, but our government bonds did extremely well last year. The rand essentially, although it ended quite stable last year, only losing about 1% against the dollar, it was a bit of a volatile bit for the rand. I mean, we're topping out at about 1950 last year to a low of about 17 rand. So it has been quite volatile. But if you look at local markets, you kind of also need to look at what has been driving these local markets. I mean, it's been a case of the local stocks doing extremely well, where resources obviously has been doing quite poorly last year. But just looking at this in a different way. What I'm showing you now are all the subsectors within the JSE index, and that orange line essentially is the index. So anything on the right-hand side, of the index essentially is outperformance. So anything on this side, and then this is underperformance. And I think outside of Naspers and your tobacco counters, I mean, British American Tobacco, the majority of these shares were locally focused, inward focused companies. I mean, general retailers, food processors, your insurance business, your banks. I mean, those are companies that benefited from this tremendous influx of sentiment into this African market. And it's purely also based on how our election essentially has actually turned out. I mean, look at the companies that actually did poorly last year. I mean, on the far outer side, you've got energy stocks, essentially, which is Sasol, which had actually a torrent time. Now, if you look at the spread of returns, I mean, you've got a plus 43 and then a negative 35. And you look at this, and this is where you kind of need to have a bit of patience with your active equity managers, because throughout the year, you kind of see this picture develop. And at certain times in the market, in the year, you have seen different performance profiles. And for those who kind of have been listening to us throughout the whole year, would have noticed us kind of speak about this performance profile of active managers. And at some points in time, some of them did underperform slightly, but as you would see later on, actually they come together quite well. And obviously, we move on to the US market. And the US market is the biggest driver of global equity returns. And I'm showing two distinct charts. So the first one on the left-hand side essentially indicates as to the magnitude at which those 7 large technology stocks in the US have influenced the market. So it's a chart showing the outperformance of those 7 stocks above the rest of the S&P. So the remaining 493 stocks. Now, last year, they outperformed the rest by 32%. The year before that, it's mammoth 63%. Now, according to Goldman Sachs, their prediction is that this gap is going to start and close. So essentially, these 7 stocks drove the market last year, which essentially makes it extremely difficult for managers to kind of keep up the market when it's so concentrated. But the interesting fact is that if you look at these 7 stocks, now also kind of guides us when we kind of look at this here. If you look at these 7 stocks, their sales are quite well diversified. I mean, they only earn 49% of their they own 49% of their sales outside of the US. So that essentially can be also seen as a good thing. I mean, if you look at companies, well, the remainder of that 493, they only earn 26% of their sales outside of the US. Mid-cap stocks in the US, less, it's quarter. Your small capitalization stocks earn 21%. Now, if you kind of look at this, there might be an opportunity, because if you think about Donald Trump, and he's all about pro-America and pro-business, you can kind of see that companies that earn a lot of their sales in the US might actually do well in a Trump era, because Trump's all about cutting taxes, bringing back manufacturing to the US. So it's also something that you kind of need to kind of keep in the back of your mind. Now, if you kind of turn our attention to what do we expect in terms of the economy next year? Now, going into next year, it's going to be all about what's going to happen with the interest rates. And the one variable that will affect that is global economic growth and US economic growth, if you're kind of looking at the US at the US rates. Now, what I'm showing at the top here is the GDP growth rates for the world, developed markets and emerging markets for this year, the expectation for this year, but also the expectation for next year. Now, obviously, the world basically coming in about 2.7, but next year it's going to also be kind of flat. Obviously, emerging markets play a massive role in kind of propping up these numbers, with developed markets only hitting at about 1.8 ish this year, but also next year. But it's also, you need to understand the specific geographic areas and how that will affect markets. Now, clearly, the US is still going strong. I mean, 2.5% expectation for this year, and then obviously dropping off slightly to 2.3% next year. And this is one of the main reasons why companies in the US are still doing so well. Although they're quite expensive, and they are extremely expensive, with the economy still humming away and these earnings in these companies still ticking up, the market still has legs, although it is a expensive market. And it's also on the back of these strong GDP numbers. I mean, if you look at Europe essentially is not growing at all. I mean, it's less than 1% this year. Now, hopefully they hit 1% next year. Now, if we kind of turn our attention to China, and just apologies, the 2026 number is not 5%. It's actually, I think it's 4.3%. China growing this year, 2024, the expectation is 5%. Next year, or this year, 2025, it's 4.5%. Also, that is starting to taper off. We know China's got some problems that they need to sort out. The property market essentially is not doing them any favors. Then we kind of turn our attention to SA. Our market, although on an absolute level, we're not growing at levels where we should be. I mean, expectations is just above 1.5% this year, and then picking up to 2.5% this year. But this number can pick up. I mean, if we just sort out a couple of essential areas. The one is obviously electricity availability, which we have seen that's starting to pick up. Next one is infrastructure and more transport. So if we can, in our logistics, so if we can just maybe pay attention to this in next 2 to 3 years, essentially we can see this number starting to pick up. But obviously, going into this year, one big influence would be policy and policy direction. And that's now we're talking about Donald Trump. And the big thing on Trump is going to be tariffs. Up until now, we actually haven't heard quite a lot, which is quite strange. I think all of us kind of expected we're going to hear a lot more sooner. But the impact on tariffs, essentially, if there's a tariff, the impact will be on inflation. And what I'm kind of showing you on the chart on the left-hand side, essentially, are different scenarios of what the inflation rate in the US can do on the different tariff scenarios. I'm not going to go through each one of them. I don't want to get too technical, but essentially, the gray line essentially is baseline. There's no tariff. So you can see the US inflation will tick lower. And that's great. But as we kind of introduce various levels and sorts of tariffs, we can see all the other lines deviating from this gray line. Now, that is important because that's going to start to affect the future path of interest rates, as you can see on the right-hand side. So base case scenarios, the blue line, is that we're going to probably see 2 rate cuts in the US this year. The Fed is meeting also today, and the expectation is they're going to keep rates on hold. So the expectation is base case that in June and December we might see rate cuts, and then maybe a third one going on to next year. And even if you look at our local market, our MPC is meeting tomorrow, and the market is kind of probably priced in 25 basis points of rate cuts. But the future path of US rate cuts will also influence how our MPC, our Monetary Policy Committee, is going to set future rate paths in SA. But also depending on tariffs. I mean, if we're going to see high inflation, then obviously we might not see any rate cuts in the US. Then obviously when there's any threat of a of a recession, then probably we'll see a more deeper rate cuts in the US. So policy uncertainty will obviously play have an influence on emerging markets. Now, if you kind of look at the portfolio performance, and as you all know, we manage two ranges. The one is a active range, the one the passive range, and they kind of start from a preserver risk profile and build up to a moderate, a conservative, a moderate, and then a aggressive risk profile. Now, it's a bit of a busy chart, but essentially what I'm showing you is the performance from last year. Then since NMG internalized the management of the portfolios within NMG, and then obviously for the past 5 years, and then a since inception line chart, which I'm also showing you. Now, I'm not going to go through all the details, but from the long-term performance perspective, it's kind of good to see that we are essentially ahead of our benchmarks, and for most of the funds, or actually all of them, we are on that CPI, or not at all, quite way above that CPI plus plus target. I mean, if you just look at last year, the portfolios returned anything from 11% to as high as 14.2%. If you look at our aggressive fund, which the majority of our assets is essentially sitting in this fund. I think the one thing that I do want to mention is that CPI plus 5 is a tremendously difficult return target to consistently achieve. And what is good for us is to see that over a long term, our active portfolio is able to hit that CPI plus 5 target. And this, the difficulty of hitting a CPI plus 5 target, it's not about us, it's about, in the whole industry is struggling to kind of meet that meet this target. But if you look at a year like last year, the portfolio returning 14.2%, that's about 6% above that CPI target. So you need these types of years to kind of help you propel yourself above that target. But all in all said, we're quite happy with the performance of the portfolios. They're meeting their benchmarks. But in any portfolio, there are certain elements that kind of worked for you tremendously. But there are always one or two elements that didn't work out as you kind of expected throughout the year. Now, if you kind of look at last year, I mean, what definitely worked for us, and I mentioned earlier, is our active equity managers, local equity managers, essentially outperformed the benchmark by 1.5%. Now, if you kind of gauge throughout the year, there are certain times where these managers underperformed, outperformed, but sometimes you need more time for your managers, for the investment thesis to play through. So we're extremely happy that our equity managers, our SA equity managers, were able to outperform their benchmark. And obviously, the next big one for us is the ability of our active bond managers to essentially outperform the benchmark by 2%. It's the one trade of South African bond managers, that they do have the tools, the tool sets, the abilities to consistently outperform this index. And we will listen to Andrew, which we're extremely excited into introducing to the portfolios, as to how they can go about achieving these returns. Obviously, there are always some elements that you feel can do better in a portfolio. And if you look at our offshore equity portfolio slightly lagging its benchmark. The portfolio still doing 19%, but slightly behind that benchmark. However, what's actually for us, what we're happy to see is that although our portfolio slightly lagged the benchmark, it still outperformed the other managers from which we could have chosen. It outperformed those managers by almost 3%. So still good manager selection on our part. So we're happy with that part also, that element of the portfolio started to pull through. And then obviously, the one allocation which didn't work out for our last year is that Signia Bravo's private equity portion that we've got in the portfolio. Given the state of the UK economy, and the fact that their earnings are still lagging, the economy is only starting to pick up. Obviously, this affected the portfolio for us last year. Then if you look at the positioning of the portfolios, and this is about how much are we allocated or invested in equity, local bonds, into cash, and then obviously offshore equity. And what I'm showing you now is how we kind of invested relative to our benchmarks. So neutral, meaning that we invest into the same proportion as our benchmark, whereas closer to over and underweight, meaning we've got more than what our benchmark has got, or we got less. And the first question you might ask is, but why are we so neutral? And the thing is, we're entering into a year where there's so much uncertainty going on globally. policy uncertainty, massive market concentration risk in the US, overvalued markets globally. So all of that brings in quite a lot of uncertainty. And so we'd rather opt for a well-diversified portfolio without taking any outright bets where we know that there isn't more certainty in achieving those returns. So you would notice two asset classes, which is overweight and underweight, and that is in South African bonds and South African cash. Now, and I just spoke about the certainty. Now, if we look at the chart at the bottom, which I'm showing here, if you look at South Africa, local bonds, they can essentially provide close to 7%, 6.7% real return. That's above inflation. So that's CPI plus 6.7%, whereas cash is going to give you anything but CPI plus 4. So, and income assets do provide a bit higher certainty in terms of the outcomes it can deliver. So just based on this, it just makes sense to kind of allocate a slightly bit more to bonds and less to income. Essentially, as we are entering into an environment where rates in South Africa might come down by another 50 or so basis points. And then also, there are 3 new managers that we will be introducing fully in this year, which obviously one you're gonna meet today, and that is Colchester, Foord, and Future Growth. Colchester, we all kind of know Foord, local manager, where Colchester is a global bond manager, which we will be introducing into the portfolios. And then just to end off in terms of fees, to give an indication of fees, so we're always kind of pedantic about fees, and we're always looking for ways to reduce fees, keep fees a bit more stable. So these are our active range fees, and we're also comparing it to kind of when we took over or internalized the portfolio. So we were able to kind of reduce those these fees. So our active aggressive sitting at about 98 basis points, and that's tearing down to 85. Now, obviously these numbers can vary a bit, anything from about, let's say 1.1% down to about 90 basis points. But the important thing is that we've always got line of sight of these fees. We know what's driving these fees, and we can actively look for ways to reduce these fees. Passive fees, a lot more stable. Obviously, it's passive, so ranging from 70 basis points to 65 basis points. And that brings me to the end of my section. Thank you so much, and we're always happy to kind of engage with our clients, with our members, and to inform you a bit more about the portfolios. Thank you very much.
Thanks very much, JB. Thank you for those insights and for going through the performance there. I'm now going to hand over to our special guest manager, Andrew Cantor from Future Growth Asset Management. Andrew, the floor is yours.
Thanks, Razia. Thanks, JB. It's really a pleasure to meet your clients, have a chance to talk a bit about what we've built over the last 30 years in the fixed interest business. I must say it's a pleasure that JB did the hard work of trying to explain Donald Trump and the global economy, so I can dodge that bullet. So just as a flyover, because it is an introduction to Future Growth. We're managing about 206 billion rand. I love that Razi introduced us as independent, but we are actually more than 50% held by Old Mutual. They're one of our largest clients, but we do maintain strong independence, and that's part of our identity. We have a staff complement of over 100, with 50 on the investment team. We outsource our back office so we can do that. We run a remarkably wide product suite. That's 51 GIPS composites, almost all of them in South African fixed interest related. I mean, 45 out of the 51 would be bond funds, money market funds, income funds, inflation-linked bond funds, active, passive, and I'll get into that in a minute. So that's a good intro to Future Growth. I think a good starting point is we have, with the support of Old Mutual and through years and years of effort, become truly Black owned. We have an independent Black shareholder now, and plus to look through to Old Mutual's Black shareholding, we are 62% Black held, and that's a bona fide number. And we're very, very proud in particular that more than half that money is held by Black women. So that's AIH Capital, by the way. That 21% is a Black women's chartered accountants organization. So it makes us proud that we've been able to re-achieve where we were 15 years ago before we sold to Old Mutual. We are therefore a BEE level 1 contributor according to the scorecards. And again, proud of the entire scorecard, not just the shareholding. So being a fixed interest manager, as I said, we do any debt instrument in this market. We can do senior debt, secured debt, unsecured debt, subordinated debt. We could do hybrid debt down near equity. In some of our funds, we even take equity positions. They're not the funds you're in, but we've been doing developmental equity investments for quite a long time as well. But the bread and butter is RAND-based debt instruments, whether it's government issued or SOE issued at times, corporate bank issued instruments, and that's what covers the broad range of this product suite. The other thing you'll know about Future Growth is, in addition to being fixed interest, where we've been a developmental investor since 1995. In fact, we're celebrating our 30th anniversary of some of our longest mandates this year, and so we'll be talking about those. That's infrastructure debt is our community property fund. We've got an agri fund. We've got a big power fund that got involved in the REIP program. It's very big. And as I said, the development equity fund. So that's the broad sweep. But notice we are a South African investor investing South African money into South Africa. We don't have pretensions to run global assets. The way we do that, and I'm going to try and bring it together so it makes some sense. When you're running 51 products, how will you bring sense to that? Well, it starts with your market view. Are you buying bonds? Are you selling bonds? I mean, JB just made the point of underweighting cash, overweighting bonds, a view which I agree with, and I'll quantify that in a minute. That's a market timing decision. Are you buying inflation bonds or nominal bonds? Or cash. So first, you've got your market timing decisions. That's a key input. Another key input is who you're investing with. You're putting money with the banks, with the government, with corporate credits, with project finance deals. Well, it depends on where you can get the most yield for the lowest risk. And we run a very complex. I mean, more than 2/3 of our investment team is doing deal making. Loans, that's credit, and even equity. And so we put all that together, and we do it through a dealing desk with good execution. And of course, portfolio construction is how you risk mitigate the other interest rate and credit positions you put into the fund. But the way I want to present this is to talk about this grinding machine. If you think about an interest rate position, we think the bank rate's going to get cut, interest rate's going to come down, the bonds might rally. Well, that affects a whole range of funds, doesn't it? Everything from your cash funds all the way out to your long duration and your inflation-linked bond funds. And you have to have an interest rate view, and you're going to fit it into 50 buckets of product. Well, you've got a fair allocation model. Here's the house view. And well, some funds don't take interest rate risk. It's a cash fund. Well, it's not going to get any of that position. Some funds take a lot of interest rate risk. They're going to get a lot of that position. Likewise with the credit. Maybe one client says, I only want listed and rated instruments with a term maturity of less than 3 years. Okay. That instrument comes down into the machine grinds it up and drops it in the buckets of those clients that only want listed, officially rated, less than 3-year instruments that are floating rate, for example. But on the other hand, if I've got a 15-year project finance deal to a wind turbine, it's unlisted, it's unrated, it's long-term, it's illiquid, and maybe there's only some of the clients will take that, but others don't. It may get a lot more yield for all those things. It drops into different buckets. So we focus on the alpha sources at the top, the potential to add return, and we drop those into the portfolios through a fair allocation mechanism. Now, if we understand that, I could talk about the funds that you're invested in. But first let me demonstrate, and it will go very quickly, but first let me demonstrate how that works in practice. This is our suite of funds that benchmark the South African short-term interest rate benchmark. That's the STEFI, we call it. It's a composite benchmark of 3, 6, 9, and 12-month NCDs, effectively. And what you can see here, if you look at the 1-year performance read from top to bottom, it's from the lowest risk fund. By the way, that's the old mutual money market fund, vanilla money market fund, all the way down to our highest risk STEFI benchmark fund. And what do you see? As you go down the spectrum, everything beats STEFI, which I'm proud of, and everything beats STEFI in proportion to the risk it's taking. What are the risks? The risks are how long is your term to maturity? Because that's liquidity risk the clients take. Can you do listed and unlisted? That's a form of liquidity risk. You can't see that here. How far down the credit spectrum you go? If a client says, well, I only want AA credits, then you can only get this much yield. If the client says, well, give me a fund with BBB credits, higher risk, more return. So you'll see that, like the power debt fund right near the bottom, it outperforms Steffi by what, 400-ish points, so just under 400 points. That's power deals, right? And so there's project finance risk, there's term maturity issues, there's illiquidity. So this proves to me that my grinding machine works, that my alpha sources come in and we're allocating interest rate risk, credit risk, term maturity risk, even some derivatives usage, and even sometimes some alternative asset classes like inflation-linked bonds going into bond funds, and it works. So with that framework of understanding how we built this investment process over the years, then we can get into the actual funds you're invested in. And there's three. I'm going to start with the relatively lowest risk, simplest fund, which is basically a money market fund. It's an enhanced money market fund. It can have an average term maturity of 180 days. That means 1/2 year is the average term maturity of all the instruments fund. So it's very short dated. It's very liquid. It's very close to being a money market fund in the market. But obviously, there's a little bit of flexibility there to take a bit more term and to take a bit more credit risk to add alpha. And what do we do? Well, over time, over, say, in this case, a 10-year track record or longer, it's about 50 points over the Steffi benchmark, and it does it consistently. So this is sort of a low risk, no surprises money market fund. It's a cash parking place, and that's what it's supposed to be. And that's what it does for clients. And we can, if we look at the attribution of where we earn those returns, it comes from the grinding wheel. You see the credit is adding about half that return, and our interest rate positions are adding about half that return. Relatively simple. Sorry, it's a busy slide, but you can see the 29 points and the 24 points in the 1 year period, adding the 54 points of total return. Very high average credit quality. It's going to be in government, treasury bills. It's going to be in banks, high grade corporates, and the like. And it's going to have a very short term maturity. Moving a bit up the spectrum, now moving to the bond universe. Now, what's the distinction? Well, bonds are longer term. That means they have interest rate risk. If rates rise, bond prices fall. You saw that fantastic bond return last year, 17% return on bonds. Well, that's because interest rates fell sharply. So not only did you get your base coupon of say 11 or 12% on the all bond index, you got a big capital gain of about 5% because rates fell. So this fund, the bond fund, takes those kind of interest rate positions, long and short, relative to the all bond index, more suitable for longer term pension fund investors who want the higher yield that bonds provide. And here, this fund benchmarks the all bond index, which is basically a government risk-free benchmark. It has a minimum liquidity requirement because the clients want flows, but it can also buy some relatively conservative credit, mostly listed, often rated. Although we do our own credit ratings, we don't rely on official ratings ever. But most of this fund will be rated instruments. And here again, you see a 1 year performance, which was very nice. We had good outperformance of a very good benchmark performance. Credit worked well last year. Our interest rate position worked pretty well last year. And over the long term, 50, 55 points of outperformance, which is satisfactory for a relatively low risk bond fund. And we could see again, the last year, the split roughly, where do the alpha sources come from? The grinding machine worked. We had some good credit positions. We didn't have any credit write-offs. And by the way, losing money in credit is not the world ending. If you're a race car driver, sometimes you're going to hit the hay bales. If you're in the credit business, you expect to have defaults and you work them out and you get your money back because the legal system generally works for you. Credit is not a dirty word like many people think. And then, of course, our interest rate positions tend to work nicely. Last year, we added 47 points over the benchmark. And again, the benchmark did very well and we beat the benchmark. So we're pretty proud of that last year. Little bit of diversity of issuers, again, dominated by the names you'd expect in the listed market. You do see a lot of what you probably think are dirty words these days, of SOEs. But let's just say these SOEs, Roads Agency, the Transnet, the ESCOM, those are all explicitly government guaranteed bonds. And the other ones, the cities, the municipalities, I wouldn't say we're great lovers of the municipalities in South Africa, but the yields are pretty good. So we do credit analysis of them and hold them for the yields and keep a close eye on them. Funny thing is, you get it for free because we're a developmental investor and we've developed our metrics for measuring social and developmental impact across the house. We could do it on every fund in the house. So I can show you a core bond fund where you didn't even ask for developmental impact, and I can show you that this fund has about nearly 30% of what we call high impact developmental investing, in this case, water, power, roads, as an example, or developmental finance. So that's something else clients can be proud of. And as I said, a lot of government guaranteed debt, so a very high average credit quality. I'm going to jump forward to the racier of the three funds you bought, and that's the yield enhanced bond fund. And here the fund benchmarks the all bond index, same kind of term mature, but now it can have a lot more credit. It can do a lot more non-government debt, if you will, in the pursuit of higher yields. And I'll show you what that looks like in a minute. And you can see it. So you can see higher risk. That means it's less liquid. It's got much more credit risk. So you might have a little more volatile returns, some dramas when somebody gets into financial difficulties, some tense trustee meetings when you have a default. And more, we could take some inflation-linked bond positions in this fund if we think inflation-linked bonds offer better value than nominal bonds, and such like that. And it works. It works. So look at this fund. It's got over a 20-year track record, and it's beat the all bond index for 20 years by over 2% per annum for 20 years, and with relative stability. It's not like 2%, but sometimes it's 6 and sometimes it's -4. It's give or take 1.5 to 2.5 every year for 20 years. It's great. The clients love this. And I mean, a 2% excess yield on a 10% base return of bonds, that's in a pension fund's life, that's fantastic. And again, we're quite proud of our performance last year. I'll show you the attribution of that. Again, the interest rate position worked not as well as in the other fund, funny enough, but some base accrual was very positive there. It means we got the part of the yield curve we were in worked for us, and the credit yield worked very nicely, 120 points. We did have some revaluations there. As you'd expect, you should always lose a little bit on credit if you're building your portfolio properly. Okay, again, interesting. This fund, it has much more unlisted assets, and because we're a developmental investor, you end up with a bunch of developmental stuff. We don't say, oh, we only put developmental investments in the clients that demanded it. Heck, I've never had a client say, I don't want developmental investments. As long as it's got the right credit profile, the right yield, it fits the mandate, by all means, I'm happy to fund the development of the country. Show me low-income housing finance. Show me consumer finance if it's done in a responsible way. And that's what you can see here. You see a very high concentration to infrastructure sectors, and as the things you'd expect in infrastructure: power, transport, water, and communications is the big four of developmental finance or infrastructure finance, as well as a range of other developmental sectors. So again, not even what the clients ask for, but you get it as part of the package. So we're quite proud of that. We're very big in the power sector, as I mentioned earlier. One of the interesting things is the way we use building blocks is not dissimilar to the way you do. You're using us as a building block in a larger portfolio. Well, we've got a building block we call the Power Debt Fund, which is 9 billion rand of power deals around the country. That's a building block that goes into this portfolio and gives you exposure to all those power deals across the country at no additional fee, never double dip fees. And I know that fees are a big focal point for investors. We charge you a fee for the fund. That's it. That's the only fee we're going to charge you. It's not an additional fee because you buy another product. Okay. And then the credit quality, as you'd expect, less government, a lot more of a spread of credit across the spectrum, and including some things that honestly are in default. And we're working them out, taking security where we can of a building, of a fleet of trucks, of a student res, or whatever it is that's defaulted. We'll step in and manage those businesses. We're never panic sellers in a credit crisis. I've got a substantial credit team. We work things out. We work alongside banks to get the client's money back. Okay. I think I'll jump forward from there. So that's what Future Growth's about. We're a leader in South African fixed interest. We add alpha principally with asset selection, credit, and with market views, interest rates across the spectrum of rates. Razia?
Thank you very much. Thanks, Andrew. I think we're just going to quickly skip over to our panel discussion and see if we can get a couple of questions in. And I'm going to start with you, probably what everyone would like to know. Can you give us, just what your return expectations are for the coming year, but also potentially your prediction of interest rate movements over the next 12 months?
Okay, so predictions of interest rate movements are as good as predictions of the race back, as my
Yes.
father would have told me. So let's go with that. And I must say, when I saw JB, I hadn't seen it previously. When I saw that JB had overweighted bonds, underweighted cash, I thought to myself, Viva, I'm on that page of the story right now. South African bond yields, the all bond index is yielding give or take 11%. We agree that the U.S. Fed funds rate, because the inflation is roughly around 3%, but heading down. Growth is not high, but the economy is strong. We can debate about the Trump effect, but in any case, the U.S. Fed funds are likely to fall. the South African bank rate, a very, very interesting. Let me show you. I'm going to show you this picture. The South African real policy rate is quite positive as well, and that is because our inflation outlook is looking right now. We're looking at a 4% inflation rate in the next year, give or take. Well, it will start edging up after that, but we're in a great point in the cycle. We're below 4% right now on inflation, and it's been subdued for a couple of years now after the COVID drama. And our bank rate is 7.75. So real rates at the short end are high, which means there is room in a relatively low economic growth environment for the bank rate to be cut. Right now, the market expects kind of 50 points over the next 6 to 9 months. I'll go with that. It could change, of course, up or down, but that's the current projection. Now, if you expect cash returns to be, say, 750, and bonds are starting with 11% in a good inflation environment, and arguably, and this is a very interesting question about the fiscal outlook. Now, it is possible that all of us have drunk the Kool-Aid of the elections in the GNU. We're all feeling pretty good right now, but right now it looks pretty good. When we see fiscal forecasts, we're still seeing numbers that show more than 4% deficit GDP, but we're believing it now. We're feeling better about the direction of travel of our government, and therefore there's a positive bias to the rate environment. So let's go back to base case. We've got government bonds yielding 11%. We've got a falling interest rate environment and good inflation environment. As JB said, we're earning roughly 7% real yields on the base yield of bonds. Well, I could easily get to a scenario of interest rates dropping by 50 or 100 points, which adds on 3 to 6% of returns to bonds. In other words, you could see another year of 15% return on bonds. I must tell you, I say that with deep trepidation, because the one thing we know about bonds is if they have a really great year, rarely do you get another great year in a row. This ain't equities. Bonds are mean reverting series. You get a great year and a bad year, but it's very hard right now for me to generate a bearish view based on the factors on the table today. That's it. Now, let me just be clear. The South African government has a great ability to shoot us in the foot. Another Lady R drama like we had a couple of years ago with the Trump administration, kaboom. The Colombians found that out the other day. So there's going to be some volatility out there depending on how much ego Trump and Cyril show.
Yes. Yeah. Yes, I think volatility is definitely the order of the day, given Trump has just got into power again. JB, maybe a quick question for you on your positioning. So I noticed you're neutral on everything, and then you had the underweight income, overweight bonds, which, as Andrew said, obviously makes sense given you're getting the higher yields. But just in terms of this neutral position, I think for me it makes sense given that there's so much uncertainty. In that type of uncertain environment, you don't necessarily want to take very large views in any direction because, there's just so much uncertainty going on. But do you think perhaps there should be like a slightly more defensive positioning in terms of maybe underweight equities or anything in that line, given how positive we seem to be on fixed income?
Yeah, so Razia, you asked Andrew just before about this forecasting. I've got my answer always says, give me a coin and we'll toss it and we'll see where it lands. Yeah, so I think the important thing to understand is that if we say our benchmarks are developed and built to achieve a certain outcome, and that's that return target that I spoke about, long-term return target. So the intention then is not to kind of take uncertain bets away from that benchmark that will actually erode the portfolio's ability to achieve those long-term returns. So only when you've got clear signals that you can actually add value, then we will deviate tremendously. If we talk about being conservatively positioned, we're talking about equity. So the question is, should we not have less into global equities and less into our local equities? But the thing is, if you look at our local market, and Andrew spoke about our physical position, I think we are better positioned physically and monetary-wise locally than we were in the past 10 years. So there is a potential upside that could play out into the South African economy, into the South African market. Earnings just hasn't pulled through into our market. We've seen a decade where there's hardly any earnings. Now, by saying that, you kind of think, okay, you should be overweight equities. But there is uncertainties to our market there's certain elements that need to take place. So for that, would rather, because it could be a binary outcome, would rather be kind of neutral. And if you look at the offshore market again, I mean, yes, it is quite expensive, and for that we can't allocate more. But there is a Trump effect where he's going to focus on the local economy. We are seeing those US companies that's still producing solid earnings growth. So one cannot ignore that. So again, it's a case of we have to invest somewhere. It's always relative, and without the certainty of outcome which bonds can provide to us, we kind of have to sit on our benchmark, because we know our benchmark will eventually lead us to achieving that long-term outcome that we desire for our clients.
Mm-hmm. Thanks, JB. Yeah, that makes sense. I think that makes sense in this, in this environment that we're in. It is literally binary in many circumstances. If you could get that asymmetric payoff, that's where we'd all be, right? Andrew, maybe just back to you. I know that future growth very strong on ESG. Can you just very quickly summarize for us how that's integrated into your strategies, and maybe share some examples of how ESG or responsible investing has influenced your choices?
At the risk of insulting my hostess, Future Growth does not use and has not used the phrase ESG investing. We are a responsible investor. That means
Yes.
we are. Now, I'm sorry to be so forceful about it, but the ESG movement, circa 2018-19, started becoming a political movement. We see how that's played out in the States. Future Growth, we've been a responsible investor since 1995. We've been a developmental investor since 1995, and those are two different things. Developmental means you're channeling money into developmental positive stuff. Responsible means you're allocating capital responsibly to companies that deserve it, to organizations that deserve it. So we do the both in various funds. But what do we mean? How do you do that in practice? You have to exercise some judgment, because these things are not clear. But you do look at how companies are governed, how they prepare their financial statements. You look at their impact on the world around them, and the products they serve, they provide, and the way they provide it in the world, and the way they behave in the world. And you assign. The first thing you do is you try to price for that risk. So I'm going to make a possibly a provocative example. MTN, income statement and a balance sheet like a battleship, a wonderful thing, makes tons of money over the course of 20 plus years, but unfortunately gets a reputation for wandering around Africa and the Middle East playing dirty. Frankly, there's been huge allegations, repeated allegations in the press about their behaviors in various countries, including by the Turkcell case against them for the Iranian cell phone license, the U.S. government taking them to court for literally helping the Taliban kill soldiers. I mean, bad stuff. And I'm not speaking out of turn. This is in the press, so I can't be charged with libel here. So we price for that. I'm not saying they're a generally corrupt entity at all. I'm not making that statement. What I am saying is they've done some risky stuff, and that has costs. And by the way, you look at the sequence of fines and the way they've gotten into trouble and the share price getting clobbered by these risks. It actually is true that by being, for lack of a better word, irresponsible, it has cost them money. And as an investor, we must be tuned to that. As a lender, we never rated them a AA the way everybody else did. We rate them. This answers your question. How do we fit into an investment process? We price for those things. We rate them a single A minus. What does that mean? If you're going to accept a yield pickup of, say, 50 to 70 basis points on a AA credit, at the single A minus, you're looking for 180 to 220 points. And what does that mean in practice? It means we get priced out. Other people are buying them expensive, and we're just not buying them. It doesn't mean we embargoed them. It means we just get priced out of the market. I will tell you there are other counterparties we have embargoed that we just don't want to do business. We just can't see any way to get past some of their core values of how they run their business. Now, here's the critical point I'd like to make about this, Razia. And that is, the great thing about being a bond investor is my benchmark is the all bond index, or it's the STEFI composite, which is bank NCD index. I do not have to, my team does not have to do business with these people. We can say, you know something, we don't like MTN. We don't like the way Tiger Brands behaved in the listeriosis crisis. We don't want to do business with them. We can say that, and we are not beholden to the JSE Top 40 index. If I was an equity fund manager and I had, say, Sasol with carbon emissions and Tiger Brands with listeriosis, and Glencore with commodity trading and the way they do it, and MTN with the way they do business, there's no way as an equity manager, because I am a slave to my benchmark, There's no way I could avoid those counterparties. Therefore, that's why I'm so hostile to the ESG movement as practiced, because you're stuck with those counterparties, whether they deserve the capital or not. As a responsible investor, Future Growth as a lender has the freedom and frankly the support from our clients to say, we don't need that. We don't need that. We don't have to do that. We can go lend to somebody else.
Thanks, Andrew. Don't worry, no offense taken. I do understand that responsible investing is really the aim. We're looking at sustainability and choosing the right investments for the right reasons without giving up any any return, which is always one of those myths around those types of concepts. One thing you touched
at the end of my career, at the end of my team's career, we want to be proud of the work we've done in our life. Proud of the work, not compromised. We didn't overcharge fees. We didn't lie to clients. We've produced a fair return in a fair way, in a way that's good for society and the economy. And that is not a flash in the pan. We've been doing that for 30 years.
Yeah, no, I think that's great. I mean, it just, you do look like you sleep well, and clearly there are good reasons for it. Very quickly, I just wanted to touch on credit ratings. Like Reg 28 does, there's an expectation that managers are doing their own credit rating process. And I mean, from the sounds of it, that's clearly something that you guys have an edge on, in terms of the way you rate it. Because if you were just accepting ratings from managers out there, you're very likely to actually end up, choosing instruments like an MTN, for example, without really realizing that you're not really getting the correct yield for that amount of risk that you're taking.
So it's a wide-scale philosophical question. So credit ratings were written into regulations globally from the 1980s, actually 90s, and they started getting written out of regulations after the global financial crisis, when it was finally kind of the light dawn that, oh, geez, credit ratings aren't fiduciary, they aren't fiduciaries, and asset managers should be expected to do credit analysis before they buy a bond or make a loan. And so that was a great thing. Now, interestingly, we, from 1999, I'm guessing, maybe 1998, we started writing into our mandates that we did not have to use official ratings, which I can tell you was very contentious with clients, that we were going to do our own ratings. But our clients supported that, and it turned out we were right. The official ratings turned out to be unreliable. It doesn't mean we're right. It doesn't, it's a statistical exercise. You're estimating. What are you trying to do? You're estimating a probability of default. Well, for a single A credit, your probability of default on a 5-year view is probably a 1% probability of default. It's hard to say whether it's 0.5 or 1.5. It's very subjective. And how do you turn I don't know, a set of weekly prepared financial statements into a credit rating adjustment? There's a lot of subjectivity there, but you apply your mind. You have your credit rating metrics, your debt to EBITDA, your debt to assets, or your profitability growth, or what have you. Your asset base, and your volatility. Obviously, a volatility of earnings is a big credit rating metric. And then you have your things that are like, well, what's their behavior? What's their culture? What's their product? What do they do? And you try to put those together, and we do. And then we price for that. We have, for every credit rating we have a required yield for that. So it is a risk return matrix based on let's be frank, how do equity managers run? And make, buy, hold, sell this based on a subjective view of the future. It's no different, really. And that's how we use credit ratings. By the way, I just want to say, while we use our own ratings, I wouldn't characterize them as perfect. I would never release them publicly, because that'd be both impolitic, and it's also our proprietary view of companies. But it's a guide. And what we do say to our clients is, if one of our ratings is ever above an official rating, let's say we've got rated something AA, but the official rating is single A, we have a reporting event to our clients, so they can look at it and say, oh, Future has gone off the rails. So we do report on that.
Yeah. Okay. Well, thank you. Thank you very much. Before we run out of time, Andrew, given how much experience you've got in the SA market, got a more philosophical question for you. So what has been the most challenging aspect of managing a fixed income portfolio in SA? And do you have any key lessons you'd like to share with all of us?
Wow, Razia. Can I be honest? If you look at the 30-year return on bonds, and I started my career in South African fixed interest circa the Chris Stals era. Okay, think 1990. Okay, and you look at the bond returns from, say, 1990 or 1995 to today. There's a reason I've had a great career. Bonds have paid a lot of money to investors. Considering all the drama and the risk, bonds have probably earned, I don't know, 11% compounder per annum for the last 30 plus years. So what are the challenges? Sure, there's the hassles of company defaults and the whole SOE crisis in the mid-teens, and you know, the growing a business. But honestly, I mean, I would be churlish to complain.
So there's been a bit of luck in terms of the bond market helping.
I'll take luck.
Thank you. Thanks very much, Andrew. Thanks for your comments, for your time. We do appreciate it, and we certainly look forward to the contribution that the future growth portfolios are going to make within our smart asset funds. Thanks very much. Thanks, everybody.